now we have an important man coming onto stage, Johan Reynaert.
Hi.
Welcome to Ecosummit.
Thanks for the invitation for us to speak here. I think we'll we'll stay in the same space as the former speaker. So the EEF is a rather important investor, fund investor in the cleantech space in Europe. And with this presentation, we want to share a bit of the findings of the lessons learned from our experiences in that field. Lessons learned from our side, but also for all stakeholders in the system, so for entrepreneurs and fund managers. Further on in the presentation, I'll present some data, which is actually data from all of our investments in Europe, but that data is kind of averaged or aggregated all over the funds, so we're not disclosing any details on particular funds, individual funds. So the EEF is Europe's largest investor in European VC. We have invested in more than 260 funds, which have more than almost 4,000 companies, underlying companies. And we have relations with 170 fund managers throughout Europe. We have a pretty good overview of what's happening on the European market. We're investing in 80% of the European venture funds. That doesn't want to say that our selection criteria are pretty low. On the contrary, we have a success rate of 20%, so 80% of the funds that approach us don't receive any funding. We also have a policy mandate, so we back first-time funds, for example, and we also take initiatives in, let's say, less developed markets in Europe where the VC and the startup ecosystem is less developed. For example, we have taken initiatives in the Baltics, Eastern Europe, to establish a system over there. So our approach is collaborative and with a focus on creating an impact in our markets. We have a toolbox approach. We set up new partnerships in certain geographies. For example, the Dutch Venture Initiative or the Luxembourg Future Fund, or initiatives we set up with local governments to increase the strength of the ecosystem there. We've also set up the European Angel Fund co-investment scheme. What is that exactly? That's we look in different geographies for angel investors with whom we co-invest together, and that's exactly to strengthen the investments in seed and early stage, particularly seed and angel investments in those countries. And we start new initiatives like the Corp, by which we invite corporates to invest in startup companies and to use us as a leverage to increase the capital that flows to startup companies in Europe. Particularly to sustainability, we've invested in about 360 million in pure play sustainability funds since 2006. These are 16 funds spread over Europe. There is a strong pipeline of cleantech funds that have approached us. And on average, if you look more generally within the EEF, there's about 300 companies we have invested in, which can be attributed to the sustainability sector. This slide just gives an overview of the geographical spread of the funds we've invested in. So 16 funds that on their turn invested close to 600 million since mid-2007 in about 120 companies. This slide is not updated with the findings of yesterday evening. So if you look to the Global Top 100 ranking of 2013, 27 companies out of that are based in Europe. I think we should be proud of that. About half of them are backed by EEF funds, and you have an overview of these companies here. We're in there to make money. And that's possible. Cleantech in Europe can generate money. You have an overview here of a couple of companies that have generated returns to their VC backers. Now let's dig a bit more into the details of the the portfolio we actually have indirectly invested in. This slide will not come as a surprise. I think the countries that attract most of VC funding, or the companies are located in countries like France, United Kingdom, and Germany. The Benelux is also taking a part of that. But the funds we have invested in are not restricted only to invest in Europe. So there's the 7% that flows also to the USA. This will neither be a surprise, I think. If you look to the sectors that the funds have invested in, you see here topics that pop up that are not a surprise: advanced materials, renewable energy, energy generation, that's particularly technologies. Advanced materials jumped to the first row, kind of, because a couple of later stage companies in our portfolio have attracted substantially more capital. If you look to renewable energy, that includes also a bit of infrastructure funding. But energy generation used to be number one, and that has changed a bit over the years. What we do see here is that there is a big variety of sectors that our fund managers cover. And I think going forward, what we appreciate is that the fund managers use their skill sets, their sector know-how, in particular, very focused subsectors of clean tech, in which they have a good network, they understand the market metrics, and so on. If you look to the vintages of the funds we have invested in, and you take, let's say, the first funds, the first vintages of the 2 years, or the first 2 years, sorry, 2006, 2008, you see that there's a bit of emphasis of these funds to invest in startup early stage companies. Obviously, there's still a lot of, about 45% is still growth capital, but there was very few seed. Moving forward, the industry and the fund managers have decided perhaps to go a bit more later stage. You see that the percentage of growth investments increased to 60%, and there kind of was a gap created in the startup and early stage sector. Seed kind of took over that role, but not sufficiently. Also, if you look at seed in a couple of countries, there have been tax breakdowns to invest, for investors to invest very early stage in these seed phases, and particularly France, United Kingdom are examples of that. If you look to our entire portfolio, which is pretty young still, just imagine that investments really took off since 2008, and you try to analyze that portfolio, I would say there is about 7% portfolio winners, which are defined as companies that have a fair value above or equal to 2x. The portfolio losers, as in any portfolio, especially in VC, not all companies are doing very well. There's about 32% that have a fair value, which is less than 1%, than 1x. What do I mean with upside potential? About 2/3 of the portfolio is around there. There's a lot of companies that are still valued at cost. The portfolio is pretty young. If you look to the companies that have been invested in from 2010-11 onwards, a lot of them are still valued at cost. So the upside potential is still there. What does that give us if you compare this? If you compare clean tech with other sectors, VC sectors that institutional investors, fund investor invest in, say health tech or ICT, internet software, I think that this gives a picture which is not that different. If you look to the holding periods, for example, that's a bit different. So we see in our portfolio we have got 4 realized full exits with an average holding time of 4 years, which is not that bad if you compare it to for example, early stage health tech. But the number of exits is a bit disappointing, and I think that's feedback to the industry. We really have to work on creating that value in a certain time window. On the next slide, a graph, don't run away. I'll explain you. So what is shown there on the red curve, the portfolio company valuation is shown, fully diluted post-money, at the moment of the initial investment of the fund in that company. The orange curve is just the Morgan Stanley, the MSCI index for European small mid-cap companies, and is showing the value of these companies basically as perceived in the market. And from 2007, mid-2007 onwards, you see that that is decreasing and in line with the economic crisis at the time. But however, you see cleantech valuations mid-2008, going and flowing into 2009, were pretty high at the time. And just imagine, we're talking about the time that Al Gore was traveling around the world promoting cleantech and the world to do something on climate change. Valuations dropped. 2009-10 became a lot more attractive, and so on. What the data we've taken here is coming from the subclass of companies, which is the startup and early stage companies, which is about half of the portfolio we've invested in. So that's a pretty, I would say, a significant data set we have here. What do we learn from this, apart from showing this curve? If you look then to the successful exits we have in our portfolio, all of these companies, the initial investment was made post, what I would say, post-hype, from mid-2008 to 2009 onwards. That is a moment where fund investors could find attractive valuations, and probably also entrepreneurs became more realistic in their expectations in their business plans. And that led to successful exits, as mentioned in one of the former slides, in just a couple of years. So it's possible within cleantech to generate returns for investors in a couple of years. The portfolio winners I've discussed in one of the former slides, all of them originate also from a time post the 2008 hype. General takeaways, I think we've seen in the market that sustainability is maturing. After the heydays, everybody got back to realism. We prefer, going forward, fund managers to focus on subsectors where they have built up a lot of know-how. And I think everybody in this room, entrepreneurs, fund managers, should really focus on reducing holding times and creating value. We've seen in the market that the value creation drivers within this cleantech subclass are much better understood. It's a capital-intensive business often, but people have learned how to deal with that. We also know that the time for adopting novel technologies in the industry is pretty long. Also, the fund managers, the entrepreneurs have learned to deal with that. And from my former slide, I think it's pretty clear that the timing of entry and exiting is very important in creating value. Last but not least, greed is not good. We've seen if valuations are too high, if expectations are too high, it's pretty hard to get to a good deal. And a good deal that perhaps is satisfactory at the moment that you're closing it, but actually you're being accounted for, both entrepreneurs and fund managers, at the moment of the exit when you really create value. So the eagerness to succeed should be there to succeed in making a good exit value. That's the messages I wanted to bring. So I hope there's some questions left.
Thank you very much. Do you have a question for Johan of the European Investment Fund? Now is the time to raise your hand and wait for the microphone.
You guys are an incredibly important player in this ecosystem and aren't particularly well known despite that. What's your view, given your contact with VCs and your own funds to deploy, on the available capital in the European context for clean tech investing? I mean, it has been going down, down, down. Mm-hmm. Are we at the bottom yet, or 2015 will be worse again? Or just given your pivotal role, what's your perspective on that, please?
Yeah. No, I think the situation is better in general for venture capital in Europe. We see funds are struggling perhaps still to have their initial closing, but then once that has happened, we really see the fundraising taking off. And institutional investors that have kind of backed out or left the space 3-4 years ago are coming back again. Particular to clean tech, it's challenging. The picture we've drafted here is a realistic picture. It's good to convey that to the public. But also there, we focus, and I think the market in general is focusing on people that have proven to deliver, that can make a difference, and that are specializing in subsectors. Right.
I have one question for you. At the EIF, you want to back first-time funds. Raising a first-time fund is the most difficult task. You can imagine, or I can imagine, and many people here can imagine. Did you actually back a first-time fund recently in the last couple of years? If I look at your list, most of them have been raising a second fund, right?
In general, if over all the sectors we're talking about, definitely. As we speak, we're backing first-time funds. We're closing these deals as we speak. But more particularly within clean tech, it's yes, perhaps we have not been that active supporting first-time funds, but we're considering a couple of them. So I think what we want to see...
There are a few in the pipeline.
Yes, what we want to see is even if it's a first-time team, a team that is composed of people that have some credibility in the market, that have shown to live, to create some return, and that have lived through a fund cycle before. So if they bring that experience, I think it's something we really will consider.
Yeah. So it will be difficult if there is nobody in the team with any VC experience, then it will be very tough to raise a first-time fund.
It's like wanting to drive a car and you don't have a driving license. You know,
All right. So one final hint for you, Johan can also make a couple of introductions to startups, to clean tech VCs that you know quite well. Yeah. So it means don't run after him now 100 at the same time, but he could be a source of VC contacts for you. Okay. Thank you very much, Johan, for coming onto stage.